Thinking about your future? Your RRSP could be the key to unlocking major tax savings and a comfortable retirement. But are you using it the right way? In this video, I'll break down everything you need to know: how it works, how to maximize your contributions, and common mistakes to avoid. RRSP stands for Registered Retirement Savings Plan, a tax-advantaged investment account in Canada designed to help individuals save for retirement. Contributions to an RRSP are tax-deductible, meaning they reduce your taxable income for the year, and investments grow tax-free until withdrawal. To reiterate, any income earned in the RRSP is usually exempted from tax if the funds remain in the plan, and taxes become payable when payments are received from the plan. Contribution limits are set by the CRA, which is the lower of 18% of one's earned income in the previous year, or the annual maximum contribution limit. The maximum contribution limit for the 2025 tax year is $32,490 Canadian dollars, up from $31,560 Canadian dollars in 2024. The deadline to contribute to your RRSP for the 2024 tax year was March 3, 2025. Contributions made after this date will count toward the 2025 tax year. It is important to note that any unused contribution room from previous years can be carried forward, allowing you to contribute more in future years if you haven't maximized your contributions in the past. An RRSP can be set up through a financial institution such as a bank, credit union, trust, or insurance company. Your financial institution will provide advice on the types of RRSP available and the investments they can contain. For married couples, it can be advantageous to set up a spousal RRSP. This type of plan can help ensure that retirement income is more evenly split between a couple. The benefit is greatest if a higher income spouse contributes to an RRSP for a lower income spouse. The contributor receives the short-term benefit of the tax deduction for the contributions, and the annuitant, who is likely to be in a lower tax bracket during retirement, receives the income and reports it on their income tax and benefits return. You can claim a deduction for contributions you made to your RRSP and that of your spouse, both for the current year and unused contributions from previous years. It is also possible to set up a self-directed RRSP if you prefer to build and manage your own investment portfolio by buying and selling a variety of different types of investments. However, if you are considering this type of RRSP, it is advisable to consult your financial institution. Your RRSP contribution in any year must not exceed the contribution room for that year, in addition to unused contribution room of previous years, plus a maximum of $2,000 Canadian dollars allowance. If it does, a 1% tax per month becomes payable on the excess. For every month, the excess amount remains in your account. It is imperative to state here that only those who are 18 years and older at any time in 2023 qualify for the additional $2,000 Canadian dollars allowance. RRSPs can be locked in. This indicates that withdrawal of funds is not allowed from them until a stipulated time, but if they are not locked in, funds can be withdrawn at any time. You can find out from your RRSP issuer if your RRSP is locked in or not. When funds are withdrawn from an RRSP, the financial institution withholds the tax. The rates depend on your residency and the amount you withdraw. For residents of Canada, the rates are 10%, 5% in Quebec, on amounts up to $5,000, 20%, 10% in Quebec, on amounts of $5,000 and over, up to and including $15,000, and 30%, 15% in Quebec, on amounts over $15,000. RRSPs are advantageous for investment planning, retirement planning, and tax planning. Investment planning necessitates that you identify your investment goals and risk tolerance, and then you create a diversified investment portfolio to grow wealth over time. When planning for retirement, it is important that you estimate your future financial needs and expenses, and make regular contributions to your retirement accounts, typically TFSA and RRSP. Tax planning requires a robust understanding of the impact of taxes on income, investments, and expenses, and then implementing strategies to minimize tax liabilities and take advantage of tax benefits. In summary, the key features of an RRSP includes 1. Tax-deductible contributions, lowering your taxable income so that you pay less tax now. 2. Tax-deferred growth, your investments grow without being taxed until withdrawal. 3. Contribution limits of 18% of previous year's income up to an annual maximum set by CRA. 4. Withdrawals are taxable. Funds are taxed as income when withdrawn, typically in retirement when your tax rate is lower. And lastly, 5. Allowance of tax-free RRSP withdrawals for a first home or education with repayment required. Maximizing your RRSP is one of the smartest moves you can make for your financial future. Whether you're just getting started or looking to optimize your contributions, the key is to act today and not delay. Now, what are your thoughts on RRSPs? Have you started contributing, or do you have questions? Send me an email at pennywise071213@gmail.com or ask them in the comments section below. I'd love to hear from you. If you found this video helpful, don't forget to share, like, subscribe, and hit the notification bell so you never miss future insights on investing and personal finance. Your financial future starts now. Let's build wealth together. See you in my next video by God's grace.